What's up? Damon here from StockBarometer.com. Today I'm going to be talking about hedging with options, but I'm not going to be talking about all the different types of hedging with options, simply because there's too many. I'm going to bring this into play by first explaining a concept I first met when I was doing my graduate studies in psychology. That concept is called prospect theory. Prospect theory says that humans have a natural tendency to inflate small probabilities that are attached to large numbers. An easy example of this is the lottery ticket. How many people buy lottery tickets? The majority of people I've asked have bought a lottery ticket at least once in their lifetime. But it's not a rational decision. Everybody knows that. If you continually buy lottery tickets over a long period of time, you're going to be out a lot of money, because the expected value of a lottery ticket is actually lower than the price you're paying. So even if you are to win the lottery one day, the amount spent on buying those lottery tickets will exceed the amount gained from the winnings. Prospect theory explains why we do stupid shit like that. We inflate these tiny probabilities associated with really large numbers. So in our minds, it might not apply to others, but it applies to ourselves. We are more likely to win the lottery than the objective probability would say. That's just a human bias. That's example one, and that's an example most people can agree with. Now here's example two that a lot of people are going to disagree with, but I'll explain it to you in a way to where it's undeniable. Insurance. Insurance is the same idea here, because what you're doing is you're paying monthly fee to protect yourself against a small probability that's attached to a large number. That small probability might be the probability of getting hit by a car and falling into a coma. The money associated with that, of keeping you alive in the hospital, is large. We are willing to pay for that protection. That small probability attached to the large number kind of drives us to that decision. Now, if insurance was a reasonable, you can say investment, if it was a reasonable investment, then the insurance companies wouldn't be profitable. It would be a zero-sum game. It is a zero-sum game because no money is being made. Money is only being exchanged. You give a premium to the insurance company, and once in a while, somebody will get money from the insurance company. But the money that comes out of the insurance company is less than the money that goes into the insurance company. Therefore, the insurance money is actually, that you're paying, is actually not worth it. You're not buying something that's fair. You are buying something that doesn't make sense. Unless, of course, you're legally obligated to buy it, like car insurance and health insurance now that Obamacare is in effect. So why do we do these things? Well, evolutionary psychology has just made our brains that way. We see these small chances, maybe we're risk-seeking, and we go with them. Now, how does prospect theory play in options? Well, it really doesn't. It's more like saying, the examples I just gave you are now market fair. Lottery tickets are now market fair. Insurance is now market fair. Now, the analogy I'm making here is that a call option or a put option is like a lottery ticket. But now it's fair, because if you keep buying options over the long term, your expected value is zero. The money you lose is going to equal the money you make, barring commissions. Likewise, if you're selling those options, the money you lose is going to equal out the money you make in the long term, because these are market fair derivatives, or market fair securities. Who's making money here? Well, the middlemen are making money, so let's take them out of the equation and just talk about how to hedge options with the idea of lottery tickets and insurance. A lot of people are going to understand immediately what this concept is, but I'm going to give you two strategies. One is a little more advanced, but these are two of the best strategies you can use as a beginner in trading options. The first one is buying a lottery ticket while selling insurance. Actually, both of them are like this, but here's the idea. Here's something you've got to understand. all options have an expiry date. That expiration date might be a month. Let's, for this example, use 1 month. We're going to buy a lottery ticket for the stock Microsoft. And our idea is this. Microsoft right now is priced at 45 bucks. We believe at the end of the month it's going to reach 49 bucks. We buy a lottery ticket for, let's say, $100, and at the end of the month, if we're right, that lottery ticket is now worth $400 more because the stock is at $49. For every $1 increase in the stock price, our lottery ticket increases $100 in inherent value. The only problem with this lottery ticket is that the closer it gets to the expiration date, the less inherent value it has. That's called time decay. So our lottery ticket is a ticket that is losing money if the stock stays the same. It also loses money if the stock drops. But if the stock goes up, we're not sure if we're making money or losing money yet. The reason is, if the stock doesn't go up quickly enough, the time decay in the call option might exceed the increase that we get from watching the underlying stock. Now, if that happens, we can't be sure that if we made our prediction and our prediction is correct, that the lottery ticket is going to be, that much more expensive than what we bought it for, and we can make a profit off of it. So how do we hedge against this? The idea of hedging against this is you buy the lottery ticket at $100 that says we're going to predict Microsoft is going to 49, but at the same time you sell insurance that says if Microsoft hits $50, I've got to pay you money. Now, because our technical analysis or fundamental analysis is solid, we've made a good, behind all of this is a good analytical method. We're not making random guesses here. So let's say you have a legitimate reason to believe that Microsoft is going up to 49 bucks. In that case, you know that it's not going to surpass $49. To be safe, we're going to sell insurance at $50. So let's say the insurance we sell, also known as selling a call option, is worth 50 bucks. We sell that insurance for 50 bucks. We buy a lottery ticket for 100 bucks. In all, we've spent 50 bucks. We've made that call option 50 bucks less expensive. And at the end, if we're right, here's what happens. The lottery ticket goes up in value, probably somewhere around $400, but because of time decay, maybe it only goes up $300. And at the same time, because the stock never reached 50, it only went up to 49, the insurance we sold expires worthless. So the money that we already got from selling the insurance stays in our pockets. It's just like when you pay your insurance company for this month's insurance and nothing bad happens to you, the insurance company doesn't give you the money back. They keep it. It's the same idea. So we're hedging against this idea that we're going to lose money because of the expiration date. And we're also, at the same time, in a way, we're making it cheaper to buy the lottery ticket. This is called a debit spread. And you can do it in either direction. You can do it with call options, where you believe the stock's going to go up. You can do it with put options, where you believe the stock's going to go down. That's hedging strategy number 1. Hedging strategy number 2 is a little more complicated because the analysis involved needs to be a little, you need to understand or have a good prediction of how quickly the stock is going to go up to that target price. Let's say we are dealing with the same situation, but we believe that the Microsoft stock will go up $1 per week. So it's starting at 45. We believe at the end of the month it's going to hit 49. Now, every week it's going to go up $1. So our lottery ticket that we bought, we're buying the same lottery ticket, 1 month expiration date. That lottery ticket is going to go up about $100 per week. What are we going to do to hedge? What we do is we hedge every week instead of for the whole month. We hedge each week $1 above the target price for that week. So if we believe that at the end of the week, Microsoft's stock is going to go up to 46 bucks, we sell insurance at 47 bucks. We sell a call option at 47 bucks. Wait for it to expire. If at the end of the week, what happens is we are correct, the stock does go up to $46, our lottery ticket has increased in value, the insurance we sold has expired, we keep the money. Now what do? It's the next week. We believe again the stock price is going to go up another $1. Of course, you can do another analysis to check the speed. This is more of a pivoting strategy and gives you a little more flexibility than the first hedging strategy I talked about. But the idea is the same. You now, because the stock is at 46 and you believe it's going to go up to 47, now you sell the insurance at 48. And you continue doing this until the very end of the month. You've sold 4 premiums, you've sold 4 insurance sales, and you have 1 lottery ticket that's now more expensive than what you bought it for. So overall, you made a lot of money. You've hedged by being both the insurance company and the lottery ticket purchaser in a market where those two commodities, those two items, are actually fairly priced to both the seller and the buyer. That's the hedging strategy. So one is a debit spread, and one is like a rolling debit spread where you sell the weekly options against a bought monthly option. So these are really very useful for most beginning options traders, and you'll find my friend Bubba says this is when it usually clicks for most options traders. This is when you really see that on both sides of the equation you can be making money. You don't have to be playing stock that has a time decay attached to it, which is buying a option and not hedging against it. And you don't have to be exposing yourself to unlimited risk, which is what happens when you just sell the option but you don't buy the lottery ticket. So what you're doing here is you're actually protecting yourself against risk. You're also hedging against the time decay. And at the same time, you're bringing in both immediate income by selling the insurance, and you're also investing by buying the lottery ticket. That is the idea here. I hope this helped. If you have any questions, leave them in the comments below.